Yeah. Oluwatomisin. Good evening. All right. We shall continue from when we stop. Last week, or the last time we met, we looked at capital reconstruction, a quick recap of our last discussion. We define capital reconstruction as the reorganization of a company capital structure. Capital reconstruction. We said capital reconstruction is the reorganization of a company capital structure when the company is experiencing financial difficulties. We mentioned that this reorganization or capital reconstruction might involve evaluation of assets, introduction of additional capital to the business, conversion of debt capital to equity capital, conversion of equity shares from one form to another form of equity, existing shareholders may be required to relinquish all their shares and accept smaller quantity of shares in the reconstructed company. We explained this. We said the purpose of capital reconstruction. The purpose of capital reconstruction is to find a way of allowing the company to continue in business and avoid insolvency. I'll take that again. The purpose of capital reconstruction is to find a way of allowing the company to continue in business and avoid liquidation. We explained this. We explained principle of capital reconstruction. That for a reconstruction to succeed, it must satisfy three principles. One, creditors must not be made worse off under reconstruction. Two, post-reconstruction profitability. There should be a good chance that if the company is reconstructed, the company can return to profitability. Then three, we discuss the principle of fairness. Please, can you mute Jacob? You are conflicting this class. Thank you. Principle three, the principle of fairness. Reconstruction should should be fair to all parties involved. And we explained that the concept of fairness is subjective. What is fair to one party may not be fair to another party. We explained this. We discussed the steps involved when dealing with reconstruction. We have like 6 steps. Step 1. Step number 1 states the 3 fundamental principles of reconstruction. Step number 2, consider situation in liquidation. If the company is liquidated, and the assets realized, who gets what in the event of liquidation? We explained this, and we detail the priority of distribution, how the proceeds from liquidated assets should be distributed. We itemized this the last class. From preferential creditors to fixed charge secure creditor, floating charge secure creditor, redundancy payments, unsecured creditors, preference shareholders, and ordinary shareholders. We itemized this at our last class. Step 3, cash adequacy. The cash required to implement reconstruction and the cash available for reconstruction must be equal. Step 4, text the post-reconstruction financial profitability. You must check if this company is reconstructed, can the company achieve profits? Then step 5, evaluate the attitude of the creditors group. Step 6, you draw your conclusion and make necessary recommendation. Thereafter, we consider question number 1. That question number 1, we started last week. We have solved the A part of this question, and we agreed to look at the B part of this question. I want to assume that everybody present in this class tonight were available at our last class. If that assumption is correct, then our attention will be on the part B of this question, because we have treated the part A of this question. All right. So my assumption should be correct that the number I have tonight, 10 students online. These 10 students were also available last week when we solved the question. Okay. Now let's read the question again so that we are abreast of what the question entails. I want to assume that there is no question. Okay. Let us go to the question together. I will take the reading. Any volunteer? I want to also make sure that last week somebody read for us. Forgotten the name. I think a lady read for the class. Any volunteer, please, somebody can read. Question 1. Any volunteer? There should be one person willing to read.
Okay, good evening. Let me read, please.
Now. All right,
Good
we
evening,
listen.
Illustration 1. The
Jide is
latest.
reading.
Okay.
Please go ahead.
Okay. The latest statement of financial position of Diamond Nigeria Limited is summarized below.
Okay.
Non-current asset as at net book value 28,500.
28.5 million. You can shorten it to be faster.
Okay, 28.5. Okay. Current assets, inventory and work in progress 17.5. Receivables 9 million. Total 26,500. Less current liabilities. Unsecured payables 20,000. Bank overdraft unsecured 8 million. That's 28 million. Working capital is 1.5 million. Total assets
Negative.
less current. What did you say?
I say working capital negative 1.5 million.
Yeah, negative 1.5 million. Total asset less current liabilities 27 million. Liabilities falling due after more than 1 year. We have 10% secured debenture, which is negative 15.
Please note that 10% secured
debenture. Can I continue?
Please continue.
Okay. Net assets 12 million. Okay. Capital and reserves. We have called off share capital 20 million. Statement of profit or loss 8 million negative, which gives us 12 million shareholders fund. Okay, 12 million.
Okay.
Okay. Diamond Nigeria Limited called up capital consists of 20 million naira ordinary share issued and fully paid. The non-current assets comprise freehold property with a book value of 15 million and plant and machinery.
Please let us note that freehold property book value 15 million.
Yes.
Go ahead, please.
Plant and machinery with a book value of 13.5 million.
Great.
The debentures are secured on the freehold property.
Now, please note that debentures secured on freehold property. That is what we call fixed charge. A liability is secured on a particular asset of a company. That is fees charge. All right. Please continue.
In recent years, the company suffered series of trading losses, which have brought it to the brink of liquidation. The directors estimate that in a first sale of the asset, they will realize the following amount: freehold property 10 million, plant and machinery 5 million, inventory 8.5 million, receivables 8.5 million. The cost of liquidation are estimated at 3,850,000. However, trading conditions are now improving, and the directors estimate that if new investments in plant and machinery costing 12.5 million were undertaken, the company should be able to generate annual profits before interest of 8,750,000.
Please let us note that if we invest 12.5 million in plant and machinery, the company should be able to generate annual profits before interest of 8,750,000. Let us note that. All right, please continue.
In order to take advantage of this, they have put forward the following proposed reconstruction scheme. 1. Freehold property should be written down by 5 million and plant and machinery by 5.5 million. Inventory and work in progress by 4 million and receivables by 500,000. 2. The ordinary share should be written down by 15 million and the debit balance on the statement of profit or loss written off. 3. The secured debenture holders would exchange their debenture for 7.5 million ordinary shares, 7.5 ordinary shares, and 6.5 14% on secured loan stock, repayable 5 years in 5 years' time. Okay. 4. The bank overdraft should be written off and the bank should receive 6 million, 14% on secured loan stock, repayable in 5 years' time as compensation. 5. The unsecured payables should be written down by 25%. 6. A rights issue of 1-for-1 at par to be made on the share capital after the above adjustment have been made. And 7. 12.5 million will be invested in new plant and machinery. Required: prepare a statement of financial position of the company after the completion of the reconstruction. B. Prepare a report including appropriate calculations discussing the advantage and disadvantage of the proposed reconstruction from the point of view of 1. The ordinary shareholders, 2. The secured debenture holders, 3. The bank.
All right, thank you. We appreciate that. Now the question A was treated last week. We have prepared that statement. We shall be looking at requirement 2 today. We are supposed to prepare a report. That report should include appropriate calculations discussing the advantages and disadvantages of the proposed reconstruction scheme from the viewpoint of the following stakeholders: the ordinary shareholder, secure debentures holder, and bank. Sorry, I have a temporary network glitch. Let's go on. Now it implies that to score high mark in this aspect, in this particular session, the student must be able to produce sufficient and quality information in your report. Now, how do we go about this report? Because these reports also include appropriate calculations. I want to know if this reconstruction, the advantages and disadvantages of this reconstruction from the viewpoint of ordinary shareholder. To answer this question, I will now ask myself, if the company is reconstructed, what will ordinary shareholder benefit? I will keep that aside. Alternatively, if the company is not reconstructed and the company is liquidated, what will ordinary shareholder benefit? I can now compare under reconstruction. This is the benefit accruing to the shareholders. Under liquidation, this is the benefits that the shareholder will derive. I can now compare and see the advantages and disadvantages. I will treat shareholder. Then I will go to secure debentures holder. I will ask myself, if this company is reconstructed, what would secure debentures holder benefits? Alternatively, if this company is liquidated, what will secure debentures holder receive? I will compare the two. I will make my conclusion. Then the last, I'll go to the bank. If the company is reconstructed, what will the bank benefit? On the other hand, if the company is liquidated, what will the bank benefit? All right. Let's open the whiteboard first. Just 1 minute. Please, as much as possible, we must be able to understand how to write this report. Some of us taking case study. Case study is about producing a report to a case scenario presented to you. In your report, it may require financial analysis, business analysis. All right. I'm trying to share information that we used last week. Okay. Okay, no problem. Let me come here. Please confirm you can see my whiteboard being shared. Please confirm that you can see the whiteboard being shared. Is it that yes or no?
I can't see it.
Once you cannot see it, others will not see it too. Now reconfirm to me you can see or you cannot see.
We can see it.
Once one person can see it, others will also see it. All right, Mr. Mohammed. Now let's look at that report. Of course, we will not be able to write the report 100% by writing. But I need to show you the calculation required. We now build reports around that calculation. The first thing is in your report, you are going to assume that if you are going to ask yourself, if this company is liquidated, how much can we realize from the sale of the company's assets? So your first calculation is liquidate the company. Let us see how much that can be realized from the sale of the company's products and how the proceeds will be distributed. So in your report, your first working, I'll come here now. I will take case 1. Case 1 is liquidation. Liquidation please undo. Somebody is chatting me. The person should be in this class now. Liquidation of the company. Now, what we are trying to achieve here is, if this company is liquidated, what can we realize from the sale of the assets? Please look at the question. Look at the question, please. Look at this aspect. The directors estimate that in a first sale of the assets, they will realize the following amounts. Freehold property, 10 million. Plants and machinery, 5 million. Inventory, 8.5. Receivables, 8.5. I will pick all this figure out now. I will come here. The first one is freehold property, but I won't start with that. I will go to plants machinery. We can realize 5 million. Inventory, we can get how much? 8.5. Then receivables, we can also get 8.5. Total realization, please sum up. Please sum up.
22 million.
Total realization. $22 million. This will be part of your report. Now, look at the notes following. The cost of liquidation are estimated at $3,850,000. I will go back to my whiteboard. Less liquidation costs. $3,850,000. Then net realization. I have 18,150,000. I will take this off. 150. So I can come here and remove this one. Now, let me ask the class, why are we not including proceeds from property, 10 million? Why do I exclude that proceeds from freehold property? Why? Anybody?
Is it because there's a fixed charge on it?
Thank you. You know, you ask a question back. Is it because there's a fixed charge? The reason is because there's a fixed charge. No one will explain. Where a liability is secured on a particular asset of a company, that is fixed charge. In the event that that company is in financial crisis and the asset is to be realized, any money generated from that asset must be applied to settle that particular liability. This 10 million naira cannot be given to anybody. It must be given directly to the debentures holder, because debentures are secured on freehold property. In the event of liquidation, proceeds realized from secured must be applied directly to the liability secured on it. You now come here, that's you come here now. This is like you have done work in 1 year. Be mindful of this. I can come here and do a demarcation now. Are you coming up? Go down. I can put a line to demarcate. I'll now come back. I have debentures. Debentures value is 15 million. Debentures holder has given this company 15 million loan. Let's go to it, please. Look at it here. %, secure debentures, 15 million naira. So debentures holder has given this company, Diamond Nigeria Limited, 15 million naira loan. Diamond cannot pay back, and Diamond is to be liquidated. We now realize 10 million. The 10 million will be given to secure debentures holder. Look at it. Proceed from property. How much? 10 million. Now, the debentors has given a loan of 15 million. They can only realize 10 million. That means they are left with what? How much? How much are standing?
5 million.
Thank you. Outstanding debentures. Outstanding debentures, that is 5 million. The next question is, how would debentures holder claim this balance? You know, it's a fixed charge. Imagine yourself as the debentures holder. You have given a loan to a company, and that loan is secured on the company's property. Now, the company ran into financial crisis. They can't pay you, they can't pay back the loan. Now say, okay, I have to take over the property. When you dispose the property, you realize 10 million. That means the company is still owing you 5 million balance. Now the question is, how would the debentures holder claim this balance of 5 million? Please note, the debentures holder cannot go to other property of the company. The debentures holder cannot go to other property of the company under fixed charge. The only thing they can do is to go and join other unsecured creditors to claim the balance of 5 million. In this case, we are going to put a remark here. You are going to put a remark. Debentures holder, we alongside other unsecured creditors to claim the 5 million. You must put this remark. We have taken care of fixed charge secure creditors. Remember, we are now looking at it. If the company is are going to get 22 million, we are going to pay liquidation expenses. Put it here. Costs. But for fixed charge, we cannot take it to general realization. We have treated it. Now, we are left with 18,150,000. How are we going to distribute this money now? How are we going to distribute this money? We are assuming that the company is liquidated. Who gets what? That will now take us to the priority of distribution. Please, under priority of distribution, who is going to get first? The question is to the class. Who is speaking, please?
The statutory creditors.
Okay.
Preferential creditors.
Very good. It's also correct. This statutory creditor or preferential creditors. Who are these creditors? Who are these statutory creditors or preferential creditors? We have unpaid wages, unpaid pensions, unpaid taxes. Now look at the question. Do we have unpaid wages? Do we have unpaid pension? Do we have unpaid taxes? Look at the question. If you look at the question, we don't have statutory creditors. From the question that Jide read, we are not told that we have unpaid wages, unpaid pensions, unpaid salaries. unpaid taxes. So you knock that out. After preferential creditors, who is next? The question is to the class. After preferential creditors, who collect next?
Fixed charge secured creditor.
Great. Fixed charge secured creditor. We have treated it. Look at it. Debentures, fixed charge. We have given debentures 10 million. Then debentures holder will claim the balance alongside other unsecured creditors, 5 million. That is treated. Next, after fixed charge, who is next?
Floating charge secured creditors.
Floating charge secured creditors.
In this question, do we have floating charge secured creditors? No. Next. Who is the next person to be collected?
Redundancy payment.
Good. What is redundancy payment? What is redundancy payments?
Payment to employees that are laid off.
Contracts of employee.
Thank you. That is the payments for disengaging the employees as a result of liquidation. Now, in the question, do we have anything like redundancy payments? From the question read by Mr. Jide, if you look at the question, there is no redundancy payment. Then the next person after redundancy payments, what do we have there?
Unsecured creditors.
Thank you. Unsecured creditors. Now you need to list out. Remember, you are dealing with liquidation. You now go to this. Go and pick out all your unsecured creditors. Just 1 minute. Just 1 minute.
Bank overdraft.
Let's continue, please. So we go to the question. Let us pick out the unsecured creditors.
We have the unsecured payables and bank overdraft.
Thank you. But let's also show others. Thank you. Look at it. Under current liabilities, unsecured payables, 20 million. Bank overdraft unsecured, 8 million. I will now go to my workings. I think this is full. Confirm you can see my screen being shared.
Yes, sir.
Okay, let's take it from here now. I will come here now. This is my working tree. This working will be included. Examiner says prepare a report, including appropriate calculations. This is like working tree. I will now come here. On unsecured creditors. I have 1. Unsecured payables. This is 20 million. We can shorten it with 30. I have bank overdraft, also unsecured. This is 8 million. 0, 0, 0. Is that all, please? Don't forget, in your remark, debentures holder will rank alongside other unsecured creditors to claim the 5 million. Can you see it? Debentures holder will now go and join unsecured creditors. I will now come here again.
Sorry, I can't see what you are writing on.
I didn't write anything. I'm reading what we have. Can you see this screen? Can you see my screen that I've shared?
The
Hello?
solution. Yeah, I can see the solution.
Yes, and I want to read it to you.
Oh.
Look at the comments here, please. Asterisk here. Can you see it?
I can.
Debentures holders will rank alongside other unsecured creditors to claim the 5 million. Can you see that? Is that clear, please?
Yes.
I was waiting. Okay. I will now come here and say, outstanding debentures balance. Outstanding debentures balance. That is 5,000. That's 5 million. Total unsecured. Please add 28 plus 5. That becomes 33 million. Is that not, please? This is your total unsecured creditors. This is total. We need to settle this liability. Look at our working sheet 1. We have 18,150,000. And we want to settle 33 million. Can it go round? Can this amount go round?
No, sir.
No, sir.
Definitely no. Now, how do we share it? These unsecured creditors,
Do we prorate?
nobody is bigger than the other. So we are going to prorate. That will now take me to working for. Look at my working for. Working for. I can now do like this. The net realization. Net realization.
Sorry, sir, I can't see what you're writing. I'm just seeing just case one. As I've been seeing since.
Okay, please. Oh. Please, let me check. I'm
Yes,
coming.
sir. It's just case one. Oh.
But you shouldn't keep quiet. Oh. Not going right. Let's pick out. I'm going to share it now. I've gone far with this note. Why is it becoming so difficult to share? Oh. Okay. Let me do something. Why is it becoming difficult to share this? Just 1 minute. So this is just not. Not sense in my hand. Please, just 1 minute. I'll just go in with it. Then I can see what I'm doing. To be able to. Have multiple share. Why? Please confirm you can see my screen now. Hello. Please
Yes, sir.
confirm.
I can see it.
No.
Thank you.
I just want to be sure why it's not taking multiple share. Can you see my screen?
Yes, we can see it now.
My screen showing working 3 and working 4.
Yes.
Okay. If for any reason you are not seeing the screen, don't wait at all. The intent is to, as much as possible, we want to be able to explain in the online class how the calculations were done. Okay. Let's continue. So I'll continue from here. Our net realization. Net realization will be shared, shared as follows. I will now come here. Unsecured payables as 20 million. I'll come here. The first person to collect. One. Unsecured payables. He has 20 million over total 33 million. And we are sharing how much? 18,150,000. Please share. 18 million. I can shorten this. 18.15. Please work this out. How much will unsecured payables collect?
11 million.
11 million. Sorry. I'll put it here. 11 million. That means out of 20 million, if this company is liquidated, unsecured payables will get 11 million. Thereby losing how much? Losing how much? 9 million. I will go number 2. Bank. Bank will get 8/33 multiplied by 18.15 million. How much will the bank get?
4.4 million.
4.4 million. Out of 8 million, bank can only collect 4.4 million. Losing how much?
3.6 million.
Thank you. 3.6 million. Then because of space, I still have space there. No. Like I will expand this. Can't take it again. Can't take it again. No. Okay, let me come here. I'll just put a demarcation here. Then number 3. debentures. Debentures out of 5 million over 33 multiplied by 18.15 million. How much will the debentures holder be able to get?
2.75.
2.75. Thereby losing how much? Losing
2.25 million.
2.25 million. We have distributed all the cash available. I can do a summary now. Remember that the debentures holder has gotten 10 million. Proceeds from freehold property. I want to show you that. Can you see the first page being shared?
Yes,
Hello?
sir. Yes, sir.
Now, look at this place. The debentures holder has gotten 10 million here. The proceeds from property. In addition, the debentures holder also gets 2.75 million. To do a summary, please confirm you can see my whiteboard shared newly. A new one.
Yes. Yes.
All right. We can do a under liquidation. Under liquidation. Debentures holder. Debentures holder. We collect 10 million plus 2.75. How much?
12.75.
12.75. This is collection. Collection. Losing 2.25 million. Bank, we get 4.4 million. Losing 3.6 million. We have unsecured payables. Unsecured payables. They will collect 11 million, losing 9 million. How much will ordinary shareholder collect? Is there any money remaining?
No.
No. Ordinary shareholder will collect nothing. Ordinary shareholder will collect nothing. Looking for it. Ordinary shareholders collect nothing. Nil. You know, we are stakeholder. Our consign is with the ventures holder, bank, and ordinary shareholder. So if this company is liquidated, the ordinary shareholders will receive nothing. The ventures holder will receive 12.75 million, thereby losing 2.25 million. Bank, we receive 4.4 million, thereby losing 3.6 million. This is case one. If the company is liquidated, we have shown distribution. Is that clear, please? Is that clear, please? Class is silent.
Yes, it is clear.
Yeah.
I said, if you are dealing with question on reconstruction, you are going to consider two positions. If the company is liquidated and the assets realized, who collect what? We have done that. The next one is now, if there is reconstruction, what will happen? We have looked at if the company is liquidated, what the ordinary shareholder will benefit, nothing. Because the venture holder will get 12.75 million, thereby losing 2.25 million. Bank will get 4.4 million, thereby losing 3.6 million. That's how you are going to put your reports. By the time we get to the reports now, with this will form part of our explanation in the report. Now let us go and look at case number 2. If the company is reconstructed, what will ordinary shareholder benefit? What will the ventures holder benefit? What will the bank benefit? We cannot compare it with the figures we have here. Is that point clear, please? All right. I need to share more. I'll come here. I'll open more now. I'm trying to share more whiteboard. Am I not seeing it? I should be able to see what happened. Oh, Allow me to share more, you know. What happened? Let me share more now. Let me see. And I want to keep this. I don't want to save it. Okay, because it's full. This screen. Um, let me share. I'm afraid I might have to save some of these. In just 1 minute, I want to make sure. I have so much waiting for me. Just 1 minute. This can go. Don't stop sharing. Please confirm you can see my new screen being shared.
Yes, sir.
Sir.
Okay. All right. We have looked at where the company is liquidated. We now want to look at a situation where the company is reconstructed. That will now be my case too. Let me expand it a bit. I'll come here. Case 2. Case 2. Construction. Now, if this company is reconstructed, the statements of financial position is presented in A. That, so in your report, under case 2, you now put there that if this company is reconstructed, statement of financial position is provided in part A. You are going to note it. Then ask yourself, if the reconstruction succeeds, what is the statement of profit or loss? Look at it. I'll come here now. I will make a comment like this. Should the reconstruction succeed, this is missing it. Statements of profits or loss is presented below. You are trying to tell us that the first point, if the company is reconstructed, the statement of financial position is provided in part A above. The next line, should the reconstruction succeed, comma, statement of profit or loss is presented below. Let's go to below. Look at the below now. Back to the question. Look at the below. Please look at these points. The cost of liquidation are estimated at 3,850,000. However, trading conditions are now improving, and the directors estimate that if new investments in plants and machinery costing 12.5 million were undertaken, the company should be able to generate annual profits before interest of 8,750,000. This is the figure required here. I'll come back here. Should the reconstruction succeed, statement of profit or loss is presented below. Is presented below. We now come here. Profits before interest. This is equal to 8,750,000. paid interest less interest. The interest we are going to pay. Let me go to the question. Please come and look at this aspect. Look at the statement we prepared last week. Post-reconstruction statement of financial position. Look at the statements. Yeah, look at this. Liabilities falling due after more than 1 year. 14% unsecured loan stock. This is going to debentures holder, 6.5 million. We also have 14% unsecured loan stock to bank, 6 million. That means if the company is reconstructed, we are going to pay interest on unsecured loan stock that are worth 6.5 million. We're also going to pay interest. The first one is meant for the debentures holder. Again, we are going to pay 14% unsecured loan stock interest. This interest will go to bank. Let me take you back to where we derive this. Please come back to the question. Now look at note number 3. Is reconstructed. Secure debentures holder who exchange their debentures for 7.5 million naira ordinary shares and 6.5 million naira, 14% unsecured loan stock repayable in 5 years. If you have to explain this now, debentures giving the company loan of 15 million. And the company is in financial crisis. The company directors now propose that ventures to 7.5 million naira ordinary shares. The ventures is partly converted to ordinary shares. That was 7.5 million. And partly converted to 6.5 million unsecured loan stock. That is why we said this 6.5 million is meant for debentures holder. Look at the next notes. Under reconstruction, the bank overdraft should be written off, and the bank should receive 6 million, 14% unsecured loan stock, repayable in 5 years as compensation. Excuse me, please. Let's continue. That means if the company is reconstructed, the company will have two liabilities. Long-term liability. Look at it here. Oh, I've gone too far. I want to check. I want to show that. Yeah, look at it. This is post-reconstruction statement. And look at it, please. I want to have it together. Can come here now. Please look at it. Liability falling due after more than 1 year. %14 unsecured loan stock. In brackets, to secure the debentures holder, 6 million. 14% unsecured loan stock. This one is going to bank. I can come back here now. Should the company should the reconstruction succeed? Statement of profit or loss is presented below. Profit before interest 8.5, 8,750,000. I'll now come here. Interest. I have to interest. One is to debentures holder. To debentures holder. They will get 14%. 14% of 6.5 million. Please compute. That will give you
910.
No, okay, I can shorten this. I can do 30 shorten. So that's this is 9. Okay. 9, 10. Then I'm also going to go second interest. This one is going to bank. 14% of 6 million. How much, please? That's 840. Is that not, please?
Yes, sir.
Yes, sir.
You can now deduct. That will give you profit after interest. How much, please? That should be 7 million.
Yes, sir.
Look at the question. Do we have tax? There is no tax in this question. That means technically, this is your profit after tax. If the company is reconstructed, then we can achieve a profit after tax of 7 million. Remember step number 4. Post-reconstruction financial profitability. That is, if the company is reconstructed, it must be possible to return to profitability. So if you reconstruct this company, the company can achieve profit after tax of 7 million. What next? The next thing is, how do we share these profits? This profit is meant for the shareholders. This profit is meant for the shareholders. Now, how do we share the profit to the shareholders? Now, who are the shareholders in this company now? You know, the company has been reconstructed. Let's go and look at the shareholders. Okay, look at it, please. We have share capital. Original shareholder, they have 5,000. Debentures holder converted to ordinary shares, they have 7,500. We now do rights issue. This rights issue is for original shareholder and debentures holder. The total rights issue is 12.5 million. That means if the company is reconstructed, we have two categories of shareholders. That means if this company is reconstructed, we have two categories of shareholders. We have the existing shareholders, and we have debentures holders converted to ordinary shareholders. We have two categories of shareholders. If the company is reconstructed, I can go back to my workings now. I will now do like this. Oh, let me use it. I will now say percentage shareholdings. I have existing shareholders. And I have debentures holder converted. Debentures holders converted. Before rights issue, this is before rights. Before rights, we have 5,000 here, 7,500 here. We now do rights issue. This space, will you allow me? I need a more space like this. Let me come here, please. Percentage shareholding. Percentage shareholding. I have existing shareholder, existing shareholders. I have debentures holders, debentures holders, converted, converted, okay? I will now say before rights issue. These people have 5,000. Secure debentures holder have 7.5. We now have rights issue. Rights issue. Rights issue. Under the rights issue, 1-for-1. That means for every one share, or for every share, for every one existing share, you are going to get one new share as a right. Now the question is, under the rights issue, how many shares will shareholder be entitled to? Under the rights. Under 1-for-1. Hello? Hello? Let me ask the question again. Existing shareholder have 5,000 shares before rights issue. We now want to do 1-for-1. How many new shares are we going to issue to them?
5,000.
Thank you. 5,000. That means after rights, total is equal to total. That means after the rights issue. After rights issue. After rights issue, these people will have 10,000 shares. The ventures holder have 7.5 million shares, 7,500 shares. And we are doing 1-for-1. How many would they be entitled to under rights issue? 7.5. Total become 15. If you now sum these two, you have 25,000. That is the 25,000 we're talking about here. Look at it here. The share capital is 25,000. If you now do percentage, existing shareholder, they have 10,000 over 25. That is 10 over 25. Please, what is the percentage? 10 over 25 multiplied by 100. What's the percentage? That will give you 40%. Please work it out. The ventures holder now have 15,000 shares. 15 over 25 multiplied by 100. What do you have?
60%.
60%. Totally 100%.
But sir, the original shareholders of 5 million, how did you get that 5 million? Isn't the
Were you in
question?
class last time?
Yes, sir.
Do you still have the workings?
Yes, sir.
It should be on your phone. But how we got it? Let me try and see if I can manage it. It's because, let me take you back to the question. Look at it. Okay, look at it. Look at note 2. The ordinary shares should be written down by 15 million. That is my interest. If you go back to the original balance sheet, the ordinary share is call up share capital. How much? 20 million. Can you see it?
Yes, sir. Yes, sir.
Can you see that, please?
Yes, sir. Okay.
This should be written down by 15 million. We are left with what?
5 million, sir. Okay.
That is how we got the 5 million.
All right, sir. Thank you very much. I'm good, sir.
You're welcome, please. Now, why are we so interested in this percentage of shareholding? It is because the profit will be shared based on percentage of shareholding. This profit of 7 million will be shared based on percentage of shareholding. I can now come here. I can come here. I can take this off. I think we are done with all the workings now. I need to share the profits. I can come here now. Share of profits. Existing shareholder, that is the shareholder. Existing shareholder will get 40% of 7 million. Please compute how much?
That's 2.8 million.
Of 7 million. They will get
2.8.
2.8 million. Now, the ventures holder, because they are now part of the shareholders, the ventures holder will get 60% of the profit. The ventures holders get 60% of 7 million. That will give me 4.2 million. We can comment. we have looked at, please remember, debentures will get share of profits, 4.2. Debentures holder will also get interest income on the remaining unsecured loan stock, 910. Also remember, debentures holder now control 60% of the business. Please note, look at it now. Debentures holder now have controlling interest. Is controlling 60%. If the company is reconstructed, technically the debentures holder will now dictate, because they have control, they have controlling shares. We can do the report now. We have tried to do all the calculations. Let us look at the report. Okay, look at the report. You are going to have your format. I've used my company name now. Dominance Consulting and Financial Services Limited. My company address, 10 Adedeji Street, Lagos. I'm writing to the MD, Diamond Nigerian. Okay, I need to adjust this. I'm writing to Diamond Nigerian Limited. Look at the address. The subject of my report: proposed liquidation / restructuring of your company. Your company name, Diamond Limited. Diamond Limited. You now start your report. Look at it. In order to be able to make, oh, who is conflicting this class? Okay, let's go to the report together. In order to be able to make a critical review of the proposed reconstruction of your company from the viewpoint of the following stakeholders, list the stakeholders: ordinary shareholders, secured debentures holder, and bank. That was what the examiner gave you. 3 stakeholders. Next line. It will be necessary to prepare detailed analysis of the reconstruction under liquidation and under suggested restructuring, meaning that we are going to look at this proposed reconstruction from two positions. Position one, if the company is liquidated. Position two, if the company is restructured, if the company is reconstructed as proposed. You are telling the examiner that you want to look at this reconstruction from two angles. The first angle is if the company is liquidated. The second angle is if the company is restructured. If the company capital is restructured as proposed. We now go to case one. In case of liquidation, the position of the company will be as follows. Look at it. Realizable value. Plant 5 million. Inventory, receivables 8.5. Totaling 22 million. Less liquidation expenses, 3,850,000. Amount available to creditors, that is the net realization, 18,150,000. Continuation, 10% secured debentures, 15 million. This is secured with freehold property, whose book value, 15 million, who only realize 10 million. Continue. Therefore, the 10% secured debentures will realize the security of 10 million. Thereafter, claim the balance of 5 million alongside other unsecured creditors. Can you see it? We have demonstrated this in calculation. The 10 million will go to debentures holder. Out of 15 million, they have gotten 10 million. And they will claim the balance of 5 million alongside other unsecured creditors. We continue. In this case, the total outstanding unsecured creditors will be as follows. We have unsecured payables, 20 million. Bank overdraft unsecured, 8 million. Balance payable to secured debentures holder, 5 million. Total unsecured, 33 million. We continue. The creditors, we have to share the sum of 18,150,000, which is the amount available to creditors as earlier calculated. Therefore, the proportional amounts available to creditors will be as follows. Look at it. The amount available will share as follows. Look at as follows. Unsecured payables, we get 11 million. Bank, 4.4. Secured debentures, we get 2.75. Total amount shared. We are done. We have shared the money. The sharing of the available fund will be as follows. We can comment now. Ordinary shareholders will receive nothing if the company is liquidated. Let's continue. Secure debentures holders will receive 10 million. That is from the realized asset. And also receive 2.75 million proceed from other assets. Therefore, secured debentures holder will receive a total of 10 million plus 2.75. That is 12.75 million. They will lose, look at the loss, 2.2 million. In your report, you are going to state this. This is further explanation. We have completed before. Look at it again. The debentures holder will get 12,750,000, thereby losing, out of 15 million, they have collected 12.75, losing 2,200,000. Next. This one is too much. Bank will receive 4.4 million if the company is liquidated, thereby losing 3.6 million. You have looked at liquidation. What each party will benefit. The ordinary shareholder will not get anything if the company is liquidated. Olaide, please, can you mute?
Okay.
In your report, you have explained what will happen if the company is liquidated. We now move to reconstruction. Look at it. This is case 2 now. If the reconstruction succeeds as recommended, the statement of financial position of the reconstructed company is attached. Solution A. However, should the proposed annual profit before interest be achieved, the company's statement of profit or loss will be as follows. Look at it. We have showed this working. We now go to share of profits. Look at my share of profits. This is the share of profit. If you share the profit, ordinary shareholder will get 2.8 million. Secure debentures holder will get 4.2 million. We can comment now. Evaluation of the proposed reconstruction from the viewpoint of the following stakeholders. Look at the evaluation. If the company is reconstructed, the ordinary shareholder, let me take it this way. If the company is liquidated, the ordinary shareholder receive nothing. If the company is reconstructed, on the other hand, the ordinary shareholder will get share of profit, 2.8 million. That's what you have here. The shareholder will have to invest additional 5 million in order to take up the rights issue. Shareholder will bring in 5 million naira more. Under rights issue, they will subscribe for 5 million shares. That means they are going to bring in 5 million. In exchange, they will receive a profit of 2.8 million. So my question to the class is, which one is better for ordinary shareholder? Reconstruction or liquidation?
Reconstruction.
Reconstruction.
Liquidation, they get nothing.
Good, thank you. If the company is liquidated, they will receive nothing. But if the company is reconstructed, they are going to invest additional 5 million so as to take up the right issue. In exchange, they will get a profit of 2.8 million. So, if you look at it from the surface, the construction is better for them. But look at the comments. Look at the comments here. It will appear that the reconstruction, it would appear that the reconstruction is in the best interest of the shareholders. But the validity of the profit forecast is important. If the profit forecast turns out to be wrong, the shareholder stand to lose further on their investment. Let me explain that briefly. Shareholder will bring in 5 million. With the expectation that after 1 year, the company will make profits. The profit forecast is 8,750,000. What is the assurance that if the company is reconstructed, the company will achieve that profit? It's a forecast. So we are going to put that caveat. Reconstruction appears better, but it is dependent on the validity of the profit forecast. If that forecast is not realized, then the investor, the shareholders stand to lose further on their investment. We move to secure the debentures order. If this company is reconstructed, or let's start from liquidation. If the company is liquidated, the maximum debentures order we receive is 12.75 million, thereby losing 2.25 million. On the other hand, if the company is reconstructed as proposed by the director, the debentures holder will be required to make further investment of 7.5 million. They will have to bring 7.5 million naira so as to take up the rights issue. In next stage, the debentures holder will get share of profit, 4.2 million, and also interest income, 10,000. The interest income that will go to the debentures holder is 910. So let's look at it. Is for the debentures holder, which one is better? Reconstruction or liquidation?
Liquidation.
If you reconstruct, you are going to bring in 7.5 million. Then you can get a profit of 4.2 million. You also get interest elements of 910. But in addition to these two, the debentures holder are now control 60% of the company's equity. That means technically they are the owner of the business. So what will be your final position? Should they accept reconstruction or liquidation?
Reconstruction.
You are going to put that caveat. Reconstruction appears to be better, but it is dependent on the validity of the profit forecast. You make that comment. Then move to the last person, bank. Look at bank. If the company is liquidated, bank will get 4.4 million, thereby losing 3.6 million. Alternatively, if the company is reconstructed, bank will receive annual interest $840,000 for 5 years. After which they will receive 6 million, being the principal value of 14% unsecured loan stock. So if banks should accept reconstruction, look at it. So under reconstruction, the bank overdraft will be cancelled, 8 million. and bank will be giving 14% unsecured loan stock of 6 million. That means if reconstruction takes place, bank will lose 2 million. So the question to the class, which one is better for the bank? Reconstruction or liquidation? The question to the class, which one is better? Reconstruction or liquidation? Yes. Let me take that again. If the company is liquidated, bank will only get 4.4 million, thereby losing 3.6 million. Alternatively, if the company is reconstructed, the bank overdraft of 8 million will be cancelled and replaced with 14% unsecured loan stock of 6 million. So which one is better for the bank? Reconstruction or liquidation?
Reconstruction.
Reconstruction. But you have to take that caveat. Yes, with reconstruction, they will get 6 million in 5 years. They will get annual interest from year 1 to 5. The net present value of cash flow. You don't even need to do that. Reconstruction appears better, but again, bank will want confidence that the company can achieve the profit. Then you can now go to your last paragraph. It is clear from the two cases that secured debentures holder benefits most, whether on liquidation or reconstruction. However, the restructuring is in the best interest or the best option for the company and should be pursued. You now close your report, your name, and sign off. We are done with the question. We are done with that question. Any question, please?